Imagine for a moment that the entire global financial system is a colossal chessboard, and for the past 2 decades, the Iraqi dinar has been that one mysterious piece sitting in the corner, surrounded by whispers, hype, and grand promises of a game-winning move that would make early investors millionaires overnight. This is the powerful, emotionally charged narrative that has been sold to millions, but today, we are cutting through the noise with cold, hard, data-driven reality, and the truth is more complex and far more fascinating than any fictional revaluation story could ever be. The live interbank forex rate for the Iraqi dinar, as of this very moment, is not the mythical 1-to-1 or even 1-to-10 figure you see on speculative forums. It is trading firmly within a managed band of 1,300 to 1,310 IQD per US dollar. A fact unequivocally confirmed by the Central Bank of Iraq's own daily auctions and international financial wire services, which means the foundational premise of the RV or revaluation dream is built on sand, not the solid rock of actual monetary policy. Now here comes the first major twist that the gurus don't want you to understand. This stability isn't a sign of failure or a prelude to a revaluation. It is a deliberate, expensive, and strategically necessary policy choice by the Central Bank of Iraq, which is burning through its substantial foreign currency reserves, estimated to be north of $95 billion, to defend this precise exchange rate against massive internal and external pressures, including a booming black market premium that can see the dinar trade 10 to 15% weaker on the streets of Baghdad than its official rate. So if the dinar isn't about to skyrocket, what is the real breaking news? The real story, the one that impacts your financial future, is the tectonic shift happening in the global currency markets that is forcing a re-evaluation of every exotic currency, from the dinar to the Vietnamese Dong. The US dollar index, which measures the greenback against a basket of major currencies, has just wrapped up its most brutal first half in over 5 decades, plunging a staggering 10.7%. A collapse driven by shifting interest rate expectations, a flight towards other safe haven assets like gold, and a growing conviction among institutional investors that the era of dollar supremacy is facing its most serious challenge in a generation. This isn't just a statistic. It is the fundamental backdrop against which the fate of the dinar and the dong will be decided. Because a weaker dollar creates both volatility and opportunity for emerging market currencies, but it does not automatically translate to a revaluation for a currency like the dinar, which is pegged to the very dollar that is now under siege. The entire narrative of an RV is predicated on a profound misunderstanding of what a currency revaluation actually is. It is not a reward for investors or a tool for national pride. It is a severe, double-edged economic tool typically deployed by a country with a massive, persistent trade surplus, like China or Germany, to make its exports more expensive and cool down its economy. A scenario that is the polar opposite of Iraq's situation, which remains overwhelmingly dependent on importing everything from food to machinery, meaning a stronger dinar would instantly make these essential goods catastrophically more expensive for its citizens, triggering hyperinflation and social unrest. Therefore, the central question for 2025 is not when will the RV happen, but can the Central Bank of Iraq continue its high-wire act of defending the current peg? And the answer to that lies in 3 distinct, data-based scenarios that every single investor must internalize. The most likely outcome, with a probability we assess at 60%, is a continuation of the status quo, a managed float where the CBI uses its reserves to keep the dinar in its current range, leading to endless online hype, but no fundamental change, a scenario of controlled stagnation. The optimistic scenario, with a 25% probability, involves not a revaluation but a modest, gradual appreciation of perhaps 5 to 10% over the next 18 to 24 months, driven not by magic but by tangible progress like a final passage of a federal budget, a new agreement with the International Monetary Fund, or a sustained spike in global oil prices above $100 per barrel that floods the state coffers with extra cash. And then there is the bear case, the one that gets ignored in the echo chambers of optimism, which carries a 15% probability and involves a forced devaluation, where the CBI, facing depleted reserves, political deadlock, and a sharp drop in oil revenue, is compelled to officially repeg the dinar at a significantly weaker level, say 1,600 or even 1,500 to the dollar, to reflect its true economic reality. A move that would wipe out a significant portion of the value held by foreign investors and pairs and ruling forces. serve as a brutal lesson in the risks of speculative currency investing. This is the genuine high-stakes drama unfolding right now, a battle between economic fundamentals and speculative fervor. And it is absolutely critical that you understand these dynamics before we even consider the potential of the Vietnamese Dong. Because without this foundation, you are navigating a hurricane in a rowboat without a compass. So I need you to stay with me, because in the next segment we will connect these global forces directly to the live charts for the Vietnamese Dong and reveal the 5 critical, non-negotiable factors that will act as the ultimate trigger for any real sustainable movement in the Iraqi dinar. Information that is not available in any single place and is essential for anyone serious about protecting their capital and spotting a real opportunity in a sea of deliberate misinformation.
Now, let's pivot to the other side of this explosive currency equation, the Vietnamese Dong. Because if you think the story of the Iraqi dinar is a roller coaster of hope versus reality, then the narrative surrounding the Dong is a masterclass in how global economic tsunamis can create both staggering risks and hidden opportunities that the mainstream financial media is completely overlooking. While the dinar's fate is inextricably linked to underground oil reserves, the Dong's destiny is being forged in the fiery arena of global trade wars and a shocking, coordinated assault on the US dollar's century-long dominance, an event so significant that the Bank for International Settlements reports global Forex trading just hit a historic peak of $9.6 trillion per day, driven overwhelmingly by tariff-related volatility and a frantic search for dollar alternatives. This is the real breaking news that connects Baghdad to Hanoi, a worldwide financial fragmentation where the US dollar, while still involved in 89% of all trades, has just suffered its worst first-half performance in over 50 years, plunging 10.7% and signaling a fundamental loss of confidence that is causing institutional investors to flee into everything from gold, which recently shattered the $4,000 per ounce barrier, to international stocks and emerging market debt, all of which have skyrocketed as the dollar stumbles. In this tumultuous environment, the Vietnamese Dong is not just a passive spectator. It is a direct player caught between the gravitational pull of a rising China, whose yuan now accounts for 8.5% of all global Forex transactions, and the aggressive trade policies of a new US administration that has threatened tariffs on a long list of trading partners, creating a volatility superstorm that the Forex markets haven't witnessed since the great financial crisis. So, what does this mean for the Dong's live exchange rate right now? Unlike the dinar's managed peg, Vietnam employs a more flexible crawling peg, allowing for gradual adjustments, but this very flexibility makes it more immediately vulnerable to the hurricane-force winds of global capital flows, which have been pouring out of dollar-denominated assets and into emerging markets, with the Morningstar Emerging Markets Bond Index soaring by more than 10% this year alone, a clear signal that smart money is betting big on a sustained period of dollar weakness and emerging market strength. But here is the critical twist that every dinar and dong holder must understand. This massive capital rotation is not a guarantee of your success. It is the very source of unprecedented risk, because the same forces lifting these currencies today can reverse in a heartbeat based on a single tweet from the White House, an unexpected OPEC Plus decision that crushes oil prices, or a sudden shift in Federal Reserve policy, turning today's rally into tomorrow's devastating margin call. This is precisely why the number one mistake investors in these currencies make is a profound misunderstanding of liquidity. The Iraqi dinar is notoriously illiquid and thinly traded on global markets, meaning when you want to exit a large position, you might find no buyers at your price, leading to catastrophic slippage. While the dong, though more accessible, is still subject to the whims of a market where regional banks and hedge funds now account for a massive share of the surging turnover, making it a playground for professional speculators who will not hesitate to exploit retail investor sentiment. Therefore, navigating this landscape requires more than hope. It demands a ruthless, data-driven strategy built on the 5 non-negotiable pillars that ultimately dictate the future of both the dinar and the dong. First, the absolute dominance of oil production and export receipts, where Iraq remains 90% dependent, meaning any dip below $80 a barrel could trigger the bear case scenario we discussed earlier. Second, the strength and policy stance of the central bank, where the State Bank of Vietnam's reserves are a critical buffer. Third, the relentless march of fiscal reforms and the crucial lifeline of IMF support, which Iraq desperately needs to secure. Fourth, the ever-present specter of political instability, which can evaporate foreign investment overnight. And fifth, the dangerous fog of market accessibility and the constant corrosive rumors of revaluation that are designed to lure in the uninformed.
This is the ultimate reality check that separates the professional from the amateur, understanding that in 2025, currency investing is no longer about isolated national economies, but about interconnected global battles, where the weaponization of the dollar through sanctions has triggered a central bank gold rush and a strategic pivot toward assets that thrive in a de-dollarizing world, a trend that is still in its early innings and promises even more volatility ahead. So as you process this critical intelligence on the Vietnamese Dong and the 5 universal drivers of currency value, I need you to stay locked in for the final segment, where I will reveal the single most important strategy for protecting your capital in this high-stakes environment. A strategy that goes against everything the online gurus teach you, but is based on the exact same models used by institutional funds at firms like JP Morgan to hedge against catastrophic loss and identify genuine, sustainable growth in the most unpredictable Forex market of our lifetimes.
So where does all this analysis leave us? And what is the single most important, actionable strategy you can implement right now to not just protect your capital, but to potentially thrive in this new era of Forex volatility and dollar weakness? The answer lies in a complete paradigm shift, a move away from the solitary, high-risk gamble on a single exotic currency and toward a professionally diversified, multi-asset portfolio strategy that institutional investors are using right now to capitalize on the very same global trends affecting the dinar and the dong. The shocking truth, the final twist in our story, is that the online gurus pushing the RV narrative are not just wrong about the revaluation. They are steering you toward the single most dangerous approach to currency investing, which is putting all your eggs in one highly illiquid, politically unstable basket, a strategy that professional fund managers would never consider because it ignores the fundamental principle of risk management that governs all modern finance. Let's be brutally honest. The US dollar just had its worst first half in over 50 years, plunging 10.7%. And this isn't just a statistic. It's a seismic event that has triggered a massive reallocation of global capital out of dollar-denominated assets and into a diverse range of international opportunities, from European equities to emerging market bonds, which have skyrocketed by more than 10% this year alone, demonstrating where the real sustainable money is being made. This is the ultimate reality check for any serious investor. The genuine profit opportunity in 2025 isn't from a mythical dinar revaluation. It's from constructing a resilient, globally aware portfolio that can profit from a weaker dollar while being protected from its inherent risks. A strategy that involves allocating a small, calculated portion of your capital to high-potential international assets while keeping the core of your wealth in proven, diversified investments. For instance, while you might consider a very small, speculative position in emerging market currencies through a regulated fund, the bedrock of your strategy should be in assets that have historically performed well during periods of dollar weakness, such as international stock index funds, which have delivered phenomenal returns for U.S. investors this year, with the MSCI EAFE index up 22% year-to-date, a gain that was amplified by 10% purely from currency effects as the dollar fell. Furthermore, consider adding assets like gold, which has shattered the $4,000 per ounce barrier as central banks worldwide diversify their reserves away from the dollar, or local currency emerging market debt, which offers attractive yields and gains value for U.S. investors when those local currencies appreciate against the dollar. The goal is not to bet your entire future on Iraq or Vietnam, but to use a small, calculated portion of your portfolio to gain exposure to their potential economic growth through more liquid and less risky channels, such as diversified emerging market funds or even equities tied to their crucial oil infrastructure, which allows you to participate in the upside while the strict, data-driven rules of diversification protect you from a catastrophic downside. This is the professional's playbook, a strategy that acknowledges the exciting potential of global shifts without falling for the seductive and dangerous myths of get-rich-quick schemes, ensuring that you are positioned to win no matter what specific path the Iraqi Dinar or Vietnamese Dong ultimately takes. Therefore, here is my final powerful call to action for you. I want you to open a new browser tab right now, and instead of searching for another RV update, I want you to research diversified emerging market bond funds and international equity index funds. And then, in the next 24 hours, schedule a consultation with a licensed, independent financial advisor who can help you build a real long-term strategy based on your individual risk tolerance and financial goals.
take the energy and hope you've been pouring into the dinar and dong speculation and redirect it into educating yourself on genuine portfolio diversification and the powerful, real-world performance of assets like dividend stock funds and REITs, which offer both income and growth potential far beyond what a static currency holding can provide. The most valuable investment you can make today is not in a currency note. It's in your own financial education and in a disciplined, strategic plan that will serve you for decades, not just for a single fleeting news cycle. Click the like button right now if this 3-part series has fundamentally changed your perspective on currency investing, and use the super chat to tell me one new, data-driven investment you are going to research first.
Most importantly, subscribe to this channel and hit the notification bell, because we are just getting started. In our next video, we will be deconstructing the top 5 diversification strategies used by JP Morgan Private Bank for high net worth clients, providing you with a blueprint to apply these elite-level tactics to your own portfolio, absolutely free. This is your moment to break free from the hype and step into the role of a sophisticated strategic investor. The information is all here for you, and the power to transform your financial future is now in your hands.